And we're back. We got another one. And here we are, episode 6, I believe. Episode 6, Epic Lunch and Learn. We're here on Mondays from 12 p.m. to 1 p.m. Central Time, trying to give you some news and notes, current events, what's going on, so you can better understand and better plan your storyline. We are live today on Facebook, LinkedIn, and YouTube, all three platforms. Some technology I figured out, so it's pretty neat. So, hello to Facebook, hello to LinkedIn, and hello to YouTube. So, if you just in the chat and want to let me know where you're listening from, I'd appreciate that. Give me some insight. And today we are going to talk about the Fed. Obviously, it's a big week. The Fed funds rate is going to be discussed, and the Federal Reserve are having a meeting on Wednesday, July 30th. So Wednesday, July 30th, in 2 days, they're going to get together and make a prediction on just where, rate will be. And a lot of people are guessing. And so we're going to figure it out. And we got Vince.
Hey man, apologize. I think I clicked on last week's link and I was sitting in the waiting room.
No worries, no worries. It's all good. It's all good. Yeah, I was
How you
just,
doing?
I'm doing good, man. Doing good. Just told everybody about obviously the Federal Reserve are going to meet on Wednesday, and that was pretty much the topic for today, episode 6. Crazy.
Yeah, I mean, I gave a little tease last week at the end there that we were going to talk about rates, right? So I guess that's what we're going to talk about today.
Yeah. I mean, obviously, to start off with just housekeeping notes, I definitely did a video on Friday about interest rates. So if you have a YouTube, go to youtube.com. Epic Spotlight is the channel. You can check out a little 6-minute, 7-minute breakdown of interest rates. Also, as well, we have a new podcast coming out, and pretty neat. I was goofing around on the phone over the weekend, and Epic Spotlight podcast is ranked now on Apple. Yeah, 180th. So we are making our way.
Climbing that ladder, buddy. Climbing that ladder.
Step by step, week by week, day by day. But we're trying to get better, trying to give you something, really lifestyle based. They put us in the business category, but to me, it's more about lifestyle. To me, it's more about just coming together and trying to provide wisdom and knowledge on a lot of platforms of happiness, love, health, and wealth, with which obviously a lot, that's basically the pillars of everyone's life.
Yeah, right. At the end of the day, that is the pillars of life.
At the end of the day. So yeah, but that's definitely some housekeeping notes that I wanted people to know about. So check out the latest episode this Wednesday, and then go back in time on Friday. We had that video, a little monologue that I put together. So how was your weekend?
Not too bad. I didn't do too much. Too much raining going on. Storms here, storms there. Some flooding, but nothing caused me any issue. But just overall, just took it kind of easy.
Yeah, no doubt. Obviously, thoughts and prayers out to anyone that has to go through flooding, living in a basement. Basements flood. Obviously, we have investors, several investors I saw. Obviously, just talk about, some of the challenges of being a real estate investor right now, just dealing with floods. My power went out on Thursday, so, just a major inconvenience as well.
Yeah, I mean, I was driving in some of it, which, rain's coming down. It's coming down. People, I don't know if snow's worse or rain at the end of the day, right? Let's just call it what it is.
Sure, no doubt. One of the things that's pretty neat about episode 6 is this is the first time that we're actually on Facebook, LinkedIn, and YouTube at the same time. We're multicasting on 3 different platforms, so I thought that was pretty neat.
Well, look at you getting all your technology all figured out.
I was trying to get Instagram, but I couldn't figure that one out at the last minute. But I will be better. Maybe episode 7, maybe we'll be on 4 platforms, but we are on 3 platforms. So definitely in the chat, let us know, where you're hearing us from. Are you on Facebook? Are you on LinkedIn? Or are you on YouTube? We're trying to meet you where you are. The Epic Lunch and Learn, the whole premise is to stay hungry for knowledge. We're trying to, bring up different topics every week that we, just have about an hour conversation on, and we take it from there. So this week, to Vince, your point, let's talk about the Fed. Let's talk about it.
Yeah, I mean, we got a 2-day meeting. I mean, at the end of the day, I don't think they're going to do much. I think it's going to be a pause. And at the end, I really don't think rates need to be cut from an economic standpoint. but from a consumer standpoint, it's needed.
Yeah, so let's get into just breaking it down for people that don't know about the Federal Reserves, how they impact our life, and so let's start off with this basic question: does the Fed set mortgage rates?
No.
That is correct. The Fed sets up the Fed funds rate, which controls short-term borrowing between banks. So banks lending to banks.
That's correct, right?
Yeah,
Short-term money between banks that the consumer can't really access.
correct. Obviously, long-term rate or long-term is more mortgage rates, and we're usually, you can kind of see us with the 10-year Treasury bond. That's
Yep.
probably a best indicator of how mortgage rates are doing.
I tell people to follow the 10-year as well. Some people in our industry will say, oh, you can follow the Fannie coupon rates and all that other stuff. But at the end of the day, mortgage-backed securities are based off of a 10-year rate because when they roll everything into the bond, that's the bond that they go and base everything off of.
Correct. But definitely, obviously, if short-term rates are lower, it may give us a sight or at least a direction of where mortgage rates may go, but they don't directly affect them.
Correct, right? I mean, at the end of the day, when rates go down, they go down for everyone in time.
Right.
If you're on a cycle of easing, one cut doesn't necessarily do that. It's a series of cuts. And again, it's over a 6 month to 9 month period until you start actually seeing those cuts turn into what we would call consumer rates.
Got it. And then I thought it was good to ask because a lot of people, that are unfamiliar with the Federal Reserve, they say, why do the Fed, cut rates or increase rates? Do you have insight on that?
Well, I mean, the Fed cuts interest rates to stimulate the economy, whether that's the
Right.
consumer spending or whether that's business spending. And let's be honest, business spending is what drives economic growth. The consumer buying things creates that demand, but businesses have to be willing to invest in their own business in order to grow, and lower rates accomplish that goal.
Correct. I think the key point is the Federal Reserve, their main job is two things. It's to protect against inflation and protect against unemployment. You know, and and
Yes.
and so that's kind of what they're trying to find that thin, fine line to do both.
And
Inflation is a
and
major
we have
issue.
those numbers coming out on Friday too for employment
Yeah.
numbers. We have numbers coming out all week long, right? And you
Yes,
touched on it. A recession doesn't happen unless people are losing their jobs.
correct.
And we're not having major job losses, but we're not having major job gains.
Correct.
And with that being said, the economy is stable. And yes, things are more expensive and everything that goes with it, but a mortgage rate cut is really not going to do enough to promote additional growth.
Yeah, I think it's an interesting note to just think about. Basically, what I would say is that markets expect pauses, and pauses, just like our economy, it's like layers, like an onion. Onion has 7 layers, so it's just a layers of risk, layers of the market. So to your point, unemployment, how are businesses handling things, how are we dealing with the tariffs? Tariffs has kind of been that bugaboo. That's we hear the word, but we really haven't felt it yet. And so there is apprehension from a business perspective of like, should we engage on continue to hire and R&D, some new products, or should we pause to see how this is going to impact our bottom line?
Yeah, I mean, it's funny you use an onion and the layers that go with it, right? But we haven't shed many tears peeling back those onions right now. When you really
Correct.
look at it, like what happened in April with the tariffs caused to create a massive drop and then all of a sudden a V recovery, right? And now we're on to the next. And people forget about what's going to go on with the tariffs. They are going to increase prices.
Correct.
And we're probably not going to see those increases until October or November.
Well, I think that that's got everyone with some apprehension is that they're waiting for this anvil to drop, and it just hasn't dropped. And so
Yeah.
it's been one of those kind of frustrating situations, like what's going to happen, and it's all this anxiety and really nothing has happened just yet. And so it's kind of like you have to kind of pause and just let it kind of wait it out. So I actually think it's been a great job as far as the implementation, because you have everyone, not knowing what's happening, getting scared for really nothing. It's been a way to kind of maybe slowly but surely ease it in.
Yeah, because everyone's making their little bit of move of how they want to prepare for it, and everyone's done that preparation, and now it's just sitting there waiting to see how the overall market's going to react.
Exactly. And obviously with the federal funds meeting, to your point, it's a 2-day meeting, and we really want to get a feel for the tone. I think of like sports and body language, right? A Jay Cutler reference, like how's his body language? But we want to get
Correct.
a feel for Jerome Powell and others on the direction of the market.
I think the tone of the message will change a little bit
Sure.
because they're saying two cuts, and September's the next meeting after this week. You're
Correct.
not going to you're going to get the two cuts, I believe. You're going to get one in September. You're going to get one in December. To me, the December cut is kind of pointless because the season's already over. But the tone has to change. And we touched on this last week. Trump putting the pressure on Powell when Powell was his guy that he has elected to the chair. But rates have to come down from the consumer standpoint when it's related to housing, and housing is what stimulates the economy.
No, agreed. It's one of those situations where um, I think the Federal Reserve, this time around has been inconsistent on just their evaluation. And what I mean by that is generally Jerome Powell has been a guy that has looked at the reports and then made decisions based on what he has seen. But then he started referencing in some of his testimony about, well, I want to wait and see what the tariffs are going to do before I want to make any impacts. And that's kind of where he messed up a little bit. Dare I say he messed up, but it's like, whoa, whoa, whoa. You always look backwards and make decisions. Now you're telling me you're going to look forwards and make decisions. Well, which one is it? Because you haven't done that. And, he's been the federal chair since, 2016.
I think that was him kind of doing a little political pushback, though, on Trump for putting pressure on him to just kind of throw something back at Trump and the rest of the administration saying, hey, we don't really have to do anything right now. And in reality, they don't, right? There's not major job losses.
Sure.
There's not a high rate of foreclosures. There's not delinquencies in auto loans. While those numbers are raising a little bit, they're not drastically increasing.
Yeah, I mean, I think obviously he had a target, which has never really been, at least in my years, I don't remember it being specified, but he had a target of this 2%, right? He wanted inflation to get down to 2.0,
Right.
and to some degree, at this point, I don't know if that's even possible or probable.
No.
I mean, so it was kind of an imaginary number, imaginary threshold of where he wants to get things at. I think we stand roughly about 2.9% of the last time I looked. So we're kind of there. And it's like, well, geez, I mean, how much lower do you need it to be before you'll give us a little bit of easing?
Yeah, I think the other thing, too, is that we're starting to realize what we're going to call a normal Fed without intervention, without QE, without buying back mortgage-backed securities, without reinvesting what falls off every month or every 6 months, and things of that, where the Fed is supposed to stay neutral. And I think we've had so much easing or so much, let's say, easy policy maneuvers from the Fed that the market's been able to use that to its advantage. And now that's coming off the table. And I think it's a lot of an adjustment.
Sure. One thing I brought a prop in. I was like, I brought this prop in for those. It's called The Creature from Jekyll Island by G. Edward Griffin. It's a second look at the Federal Reserve. It's a thick book. If anyone can see it, it's
Yeah.
a real thick book. It takes you a minute to get through it. But if anyone is curious, just how did the Federal Reserve come into power? How were they emboldened with this, task? This is kind of the encyclopedia, the dictionary, the Wikipedia of like how they came into power. So if anyone, insomnia or just curious, the Creature from Jekyll Island by G. Edward Griffin. I read it. Probably need to read it again. It's been a couple years. Did it during the pandemic, but it just gives you more perspective of just like who are these people? Where did they come from? Why do they have all this power? How they control and because now let's go into it. Short term, we talked about how the federal fund rate is more short term borrowing, but what are some things that really directly impact short term borrowing? What are some products that people know about, obviously?
Well, I mean, your home equity line of credit would be one that would be considered a short term.
Yep.
Your credit cards would also be the same, and things of
Car.
that. Your car.
Yeah.
Well, your car comes into a more of a fixed rate.
True.
Right. I mean, anything that's basically variable, right? I mean, we don't have the LIBOR anymore, so it's just prime.
Right.
But I mean, that's what it affects, right?
Exactly.
It would also affect people potentially in a reverse mortgage because those are variable rates as well.
Good point.
So, I mean, there is some of it, but at the end of the day, everyone's really more concerned about the mortgage rate than any other rate. And like we said earlier, if the Fed's cutting the funds rate, the overall rates are going down as well.
Correct.
Over time.
Yeah, so, I thought that was fascinating in nature of like just overall, like people have such a care about their mortgage rate, but they don't know their car rate, they don't know their credit card rate. They have no idea. Well, how much is my credit card rate?
Correct.
And it's just like,
and if you look at credit card statements today, unless you're getting an introductory rate and the introductory period's over, you're looking at 26, 27% interest rates on credit cards.
Exactly.
And in some of those cards, they could be higher. So
what are you seeing for lines of credit? Lines of credit would probably be at this point.
I'd say probably middle of eights on a true HELOC done the right way without like variation, whether you want a fixed rate or a floating. I mean, nothing more to really kind of say on that because at the end of the day, it's got to be higher than the 30-year mortgage rate. Otherwise, they wouldn't touch it or wouldn't do it.
Exactly. Yeah, I normally give people a spectrum of when they're looking at HELOCs or HELoans. HELoan is just a second mortgage that's fixed versus a HELOC that has the variable to it. But generally speaking, it's going to be somewhere between 8 to 14% based on your credit score and based on the loan to value. How much are we borrowing from your house to create this second mortgage? So sometimes when people like, it's funny because they'll hear like, oh my God, 10%, that's so high. And, to some degree, when I'm like, well, we're going to give you $50,000, 10% is basically $500 a month. And they're like, oh, that's not that bad.
Yeah, I could do that, right? That's my car payment or whatever else that would have been, right?
Correct.
But that's also an interest-only payment, so it goes nowhere.
Well, yeah, and that's what the HELoan does go into principal and interest. Usually, you got to pay it off within 20 years. But yeah, in the HELOC, definitely is more of an interest-only situation, probably for the first 5 to 10 years. So, you really have to have a game plan, and that's what I see a lot of people get stuck. I mean, how are you going to pay this off? Because you got to pay it off one way or the other.
Yeah, I mean, that's, and that comes down to planning it and figuring it out, right? It's easy for us to turn around and give a home equity line of credit. And if that is just a Band-Aid to the solution, we know that there is probably a better option. And they just the client didn't want to look at that better option at the time. They just wanted the quick fix.
Yeah, no, definitely. So as far as the 10-year treasury, one thing I put the note here, the mortgage-backed securities are priced off the 10-year treasury, generally speaking, and investors use it to guess where the economy and the inflation are going. So it's kind of like a GPS is probably the easiest way to say it.
Sure. I mean, if you pull the chart up, and I don't know if you did or the audience wants to, we've been sitting in a 10-year bond range between basically 4.25% and 4.5% for pretty much the last 6 months. We're not really any direction one way or the other. So, I mean, I think we're at 4.4 today, just thereabout. And we're going to say the 10-year basis mortgage rates. At the end of the day, we're on the higher end of the mortgage rate scale, but we've still been within 1/4 to 3/8 of a point of the low end for the entire year.
Yeah, so it really is one of those situations where we have to kind of figure out, what's best for you as the consumer. Um, I think there's a level. I mean, there's a percentage, right? There's a percentage where this stuff matters, but I don't know if it's all the be all end all. Don't get lost in the sauce, so to speak.
Correct, right? At the end of the day, if it's time to buy a house, it's time to move. Those are things you have to do, right? I
Right.
mean, mortgages can always be redone over the years. It's just what's the life event that's causing what it is. Today's topic was just kind of one of those things. It's important to the marketplace. It's important to the audience, and you're gonna hear about it come Wednesday.
Yeah, definitely. And it's an elective, to your point, like there's people every year they're going to have to move, for a certain school district, a relocation of a job, hey, we have a 3-bed, 1-bath house and my kids are getting bigger, we need more space. I mean, those are the people that are going to move every year because they have to because of life circumstances. But when you have a choice and when you like, is this a good time, is this not a good time, and you want to have some more of a what do you say, just more pros and cons. I mean, these are definitely, things that we can talk about. These are things we can bring up, as if you're timing the market. But you know if we were timers, we'd all be millionaires and probably wouldn't even be doing this call right now.
Correct. I mean, you could never time in any ways. Trying to time the market on interest rates on a home is the wrong reason to buy a house unless you're an investor. I mean, it's just
Exactly.
nothing else. There's nothing else to it on that because you always have an option to go back and redo it if something would change drastically in the market. From a financing standpoint, I mean, we've done this for 20 years now a piece. If you're not saving 3/4 to a point on the interest rate from a cost standpoint for doing a transaction, it almost doesn't make mathematical sense. Now, that could be a little bit different in today's market because we're talking higher end interest rates. There are people that are in the sevens in today's world. Some people are in the eights, and it may make sense to do it at a smaller range or a smaller benefit because it equates to more money.
Sure. And what would you define as far as a refinance rate per se that it would justify lowering? Hey, I should look into refinancing. Is it
The
a
the
point? Is it? What do you
the,
think?
the point's the theory, but I
Hmm.
guess the other point of that is if you're staying in the house, the other thing is right saving someone $100, $150. It sounds great, but in the end, what are you doing? You're recasting your loan and redoing it. So what I've kind of always tried to do with people when they go to come back to a refi, and granted, 2021 was a separate animal, so that really doesn't apply. It's to change the term. So you're in a 30. Hey, we could save you 3/4 of a point. Let's go down to a 25 or let's go down to a 20, right? Take 4 or 5 years off as opposed to saving $100. And so that 3/4 of a point is really kind of my baseline and the term savings.
I would say to that, for some, the short-term savings is a benefit. It's a breather. It's a mechanism to like, okay, I can consolidate. I'm not filing bankruptcy. Everything's piling up on me. This despair, right? When you kind of feel like, oh man, this is just becoming overwhelming. But if once again, you have to have a plan. You have to have a strategy involved because, to your point, if we're just recasting, going from 28 years, 4 months back to 30 years, and yeah, you're going to see a savings, but you're starting back over again. The goal. What is the goal? Long-term goal for this property? And these are things that you can answer for yourself. I can help you. I can kind of jog your thought process, but you have to answer these things for yourself. What is the long term game plan of that current house? Are you planning on staying there for another 5 years? Then maybe, hey, let's go back to a 30 because you're not really going to stay here anyway. The plan wasn't really to pay this off. So it is interesting. I had a conversation yesterday. This actually made me think of it. Where the property value is 275. Customer bought the property in 2016, has a 3.875 interest rate, 30-year fix, and owes roughly about 116,000. And it was kind of one of those things like, what do you think I should do? I'm fine, right? I'm fine. you know, it was, and what do you
Yeah,
think?
I mean, and I'm kind of going back to what we talked about earlier, right? The HELOC is just potentially a Band-Aid. And like you brought up, like, hey, recasting or refinancing and bringing them a 30, does that keep that person out of bankruptcy, or does that help them for the next month on, right?
Right.
So in that exact situation, your client there has $150,000 worth of equity.
Correct.
And so you talk about planning. Is it better to then take that equity and go start over somewhere else than worrying about the 3% interest rate? Because it's a 3% interest rate on $100,000.
Correct.
So it's a very, very tough call. And I mean, we did this on the very first show. You can't stay stagnant. You have to keep moving. Otherwise, you're not growing.
Yeah, talk about your concept, because it was something that actually I've never thought of. The concept of selling and getting maybe a bigger house off those numbers I just gave you. So she values 275. She owes 116. She has 3.875 on a 30-year fix. What's an idea that she could do, obviously, from there?
Well, I mean, obviously, let's say she's young. Well, let's say she's older, no kids, no nothing, right? Does it make sense to sell the house and go to a condo and try to go mortgage free? Right? I mean, that's one potential. And the other, my whole big deal on transferring equity from one home to the other will always stay there, because if you make 20%, I'm sorry, if you make $20,000 on a $200,000 house, you make $40,000 on a $400,000 house. Now, I know that sounds a lot easier than what it is, but when you're taking $150,000 into a $400,000 mortgage, now you're only financing $250,000. It's a little bit of a different play. So, that's why they allow us tax exemptions for property gains and everything, because the expectation is to roll it into the next home.
Right. So many people. It's not about not knowing some of this stuff, but the fear that kind of seeps in, where you just don't want to make the wrong move. You don't want to make the wrong decision. And I always try to tell people there is no right or wrong. But you got to make a decision.
You got to choose.
Yeah. Now this lady married with three boys. Oldest boy is 13. I think it's 13, fourth grade, and second grade. So, I mean, to some degree, I look and say the house is too small. She probably needs to go get another house. But, what's stopping her, right? It's, oh my God, interest rates are double what I have right now. Is that the right play to make? I don't want to lose this 3.875%. So you're sacrificing, kind of being comfortable, as far as just human beings getting bigger. Got three boys, all stuck, in kind of this, 1,400 square foot home. And that's an issue.
I mean, obviously, in her situation, she keeps the home. She should have a line of credit behind it to help her just in case of an emergency. Just to have it, because if you don't have it and you have an emergency, now you can't go get it.
Correct.
Because if the emergency would say be the loss of a job, now you don't qualify to go get the line of credit. So it is important to have some form of liquidity behind those low interest rates, meaning some form of a second or a line of credit or access to additional cash.
When we got in the business, both of us probably right around the beginning of the millennium, right? So I was 2002. We were the lending environment was very, very much refinance driven, but it was very reactive. The consumer got themselves into trouble, and then we were able to get them out of trouble, bail them out, so to speak, either with a refinance, a sell, what have you. And the market has changed because we have deemed, because of 2007, the housing bubble crisis, all those things, we have deemed those not good loans to be involved in. We have to be proactive. People that are, hey, I'm late, I'm 60 days late on my mortgage, I'm 90 days late on my mortgage, or, oh, I'm about to be, 2 months late on my mortgage. We can't help you.
Right. You've already hit the suffering point of your credit's been damaged. Now the lender won't allow us to finance you for up to a year until you make your payments back on time. You got to rebuild the credit. And I mean, the other thing too, and we talked with this a little bit, the government created a hedge within the mortgage market. And we take what happened in 02 to 07, you could go borrow more than 80% of the value of your home. Today you can't. So on that $250,000 home, that consumer has no access to $50,000 of that equity that they think or believe they have. So, it's a big difference. Kind of goes to the point of we've had such a structural shift in the value of housing. And when people go on YouTube or Facebook and make a video and say, oh, the housing market's going to crash or values are going to come down, where are they coming down from? They're coming down from 300 to what? 270? We're not going to see some drastic change like what we had in 08. And part of that is because you can't leverage the same amount of money against your home as to what your house is worth.
Sure.
So, but again, you can't wait for an event to happen, because if you lose a job, now you're in a bad position. So you always have to plan ahead and have an option or have an emergency fund, sort to say. And line of credit could be your emergency fund.
Definitely. And I kind of feel like that is just something that has to be a part of the arsenal, that you have to get a line of credit, even if you don't need the money, and just have it there, secure
Correct.
it, because to your point, and we talked about earlier today, if unemployment does spike and you lose your job, wouldn't it be nice to have that, line of credit available and access to money? I had a conversation with a lady that talked about her husband is unemployed. He got laid off, kind of during the pandemic, and it was such a good paying job. He really hasn't been able to find something that has, matched or been similar to. And so, obviously his pride has been kind of stopping him from, hey, I don't want to just take an ordinary job.
I don't want to go just to go to work, and I want to go back to doing what it was that I did. And I mean,
correct.
And I mean, that's the point with anybody, right? Like, I mean, you want to always succeed, you always want to grow, and so forth, right? And when people unfortunately get, let go from companies or companies downsize, it's sometimes a struggle. It's like, hey, I got to go back and rebuild. And it may take a little bit of time. And sometimes having that liquidity gives you that ability to go back and say, well, I know I need to go take this position at this company and make a little bit less, but I know I can get back to where I was because there's some opportunity to grow. And it comes back to almost investing in yourself in that situation.
I remember when, this is 2007, I got laid off, in the mortgage industry. And, I was a manager, branch manager. And so I am trying to find another branch manager job, amongst all these people that were laid off at the same time. And so they wanted me to start at the beginning and build myself up, show proof, and then take it from there. And my pride wouldn't want me to do that. I was like, no, I'm not there. I should be here.
Yeah. I mean, I kind of was in the same thing, right? I mean, I was told to, before going into mortgage sales, I was told to learn the mortgage operations. So from 06 to 08, I was bouncing from company to company because they were laying people off and someone would hire and so forth and so on. And I always wanted to try and stay within operations because I was comfortable with what I was making with operations, because I was bonusing and I was getting a salary, and I didn't want to go to sales. And then basically in 2008, it was, well, you ain't going to go find what you were making unless you go to sales. So I had no choice. And I literally entered the sales side of the industry in 07 when I got my license. So I went right into sales when we were right in the gist of the biggest mess in the history of the country when it comes to housing.
Yeah, and I think that's why our backgrounds are very similar in nature, and that decision that we made for ourselves, and that's why we encourage other people to make that same decision, because both us, I rather control my destiny and not have it dictated from a company that coming. And I didn't know who was going to make it. Honestly, I didn't know who was going to survive or not, and so it was one. It's like, do I go to Washington Mutual? Do I go to Bear Stearns?
Yeah.
And you just didn't know who was going to make it. Both of them did not. And so I said, hey, I just got to go out and make it for myself. And I, really control my own destiny.
I was working for the conglomerate at the time. I was working for Lehman under Finance America. I never thought that I would wind up having them close the doors,
Sure.
being as big as they were. So you never know what happens.
No, you
I
never
mean,
do.
even if you're working in a traditional 9 to 5, it's still your business. What I mean by it's still your business. It's still your business to pay your bills. It's still your business to take care of your responsibilities. So sometimes having those security blankets, and again, it's being reactive. I'm sorry. It's about planning ahead, because to be reactive to a situation is sometimes too late.
Correct. And we're just not lending anymore in a reactive nature. So if you get yourself into trouble, it's too late. We got to start planning and having strategies up front. And that's where I do believe the line of credit or some type of second mortgage that you're able to take out and just have it there in case of a rainy day. You don't really have to have anything on the line, but it sure as heck be nice with a $50,000 line of credit. And oh, I just lost my job. I can still pay my bills, and it's not going to be despair.
Yeah.
Not everyone's getting severance packages for 6 months or 12 months. Those are rarities. That's not the common core. I just recently spoke to someone that got laid off, and they said, well, they gave me 1 month.
Right.
Well, that puts a lot of pressure on you. Like, hey, you can pay your bills for 1 month. Hopefully, you got some savings. And to your point, even going back to me, when they laid me off, no one ever called me. I never got a phone call that said, "Hey, Dante, how's everything going? Are you paying your bills on time? Are you making it?"
Everything's great. Thanks for laying me off. Have a good day. Bye.
Right.
Right. I mean, that's
Right.
Exactly it. Right. And by having that line of credit or having access to something, maybe you can go take that job that's $10,000 less a year or $15,000 less a year, and you can say, well, I can go try this for 6 months and see where it goes, and take some of the stress and pressure off of the family responsibility of having to make sure you're working to pay the bills.
Yeah, definitely.
It may be like a blend of the two. But at the end of the day, right now, employment's pretty good in the country. Jobs need to pay more. That's a guaranteed. Wages are not rising as fast as they need to be, but companies are not really laying people off. Now, we've seen some closing of stores, like Kohl's has closed stores in the area,
Sure.
and things like that from a retail standpoint. We're starting to see some of that. And the more of that you see, the lower rates will go.
Right. Joanne Fabrics, right? I think they're TKO.
I know Microsoft cut some people right now and things like that,
Yeah.
But again, it's, to me right now, employment's stable.
Yeah. Now, one thing I wanted to bring up a topic is, the Fed is trying to get out of the mortgage business. And so I thought that was real interesting as far as, can you kind of explain quantitative easing and just, kind of where we were to where we are now?
Well, QE is pretty much over from the standpoint of the Fed reinvesting the money of mortgage-backed securities that expire every month and putting that money back into the market. That's what created the really, really low rates, because they were saying, hey, we're going to buy bonds and we're going to cut rates. So we're doing both things to ease things down. In terms of the QE is basically them reinvesting, let's just call it what would be like stock dividends from a stock portfolio, and just putting that money back to work. So there really is no QE in the marketplace today, which is why we've gotten higher interest rates as fast as they spiked up, right? Because the minute the Fed said, hey, I'm not buying anymore, what did rates do? They drastically shot up in a short-term time frame.
Right, exactly. They, one thing I would say is that the Fed bought trillions of dollars of mortgage-backed securities, during the pandemic, right? And they did that basically to, help lower the interest rates.
Yeah, I mean, look at it, right? We were lowering rates and buying the bonds back on the other side, right? So we were having cuts from both ends. In today's world, we don't have any cuts, and we're having normalization in the marketplace. The interesting thing to be, and I don't think it'll ever happen, is to see what happens with Fannie and Freddie in terms of their conservatorship within the balance sheet of the country. And for those that don't know what Fannie or Freddie is, they're basically a government agency that was purchased, or was kept open during the Great Recession by government funding. And they're basically the avenue of what sets what gets put in these mortgage-backed securities for loans to be bought to the public marketplace. But Fannie and Freddie is basically the bank for mortgages first. And then the investors basically go and buy those coupons or whichever you want to call it from them. And they're selling it out in the marketplace. So if we ever see Fannie or Freddie go to the private market, then we have a whole different housing market. And I don't think that'll ever happen.
I mean, we'll wait and see. I mean, obviously, that's what the rumor mill and the talk is all about. So the situation is that right now, currently, they're shrinking their balance sheet. So, so to put it in kind of perspective, the Fed during the pandemic to get the rates lower were basically selling mortgage-backed securities, and then they were buying them. They were actually just buying them themselves. So
Correct.
they became their own, buyer and seller of these things. Now, if they go to the marketplace and say, hey, we're not going to buy them anymore, we're just going to be the pure seller, we have to make sure that we have investors that want them for these lower yields.
Which is why I'm sorry, I didn't mean to cut you off, but good. I do that often. Which is why we had such a quick spike in interest rates. And when I mean a quick spike, in a 1 year to 18 months, we go from 4% to 7.5%.
Correct.
And that's because of that, right? Because the end investor's like, well, I'll take that mortgage paper at this or that. And then each one continue to upbid the other one. So
correct.
That's where we're basically at.
And so if we get, basically investors, a private market, a public, kind of an open market where investors have the choice to want to buy, bonds, more than likely bonds will be bought at a higher interest rate. A 4% is not sexy, 3% is not sexy. 7, 8, 9, 10% are more sexy and more in favor of an investor. So that's where, to your point, is the fear of like, are we really going to do this? Because then the thought of, seeing rates ever go lower is like, it's not going to happen.
But yeah, I mean, and you could take that to another thing. It's like playing Monopoly with the family, right? You got Boardwalk and Park Place. That's your mortgage. You're sitting on the railroads. Those are your credit cards. And the banks are pushing up the rates on everything else because they can't push the rates up on your mortgage unless you sell the property. So it's kind of a balancing act. Everyone's trying to get a higher interest rate because there's such low interest rates in the mortgages that are out there.
Right. So it is interesting to say the least. It is interesting to say the least. So that's more of a speculation that we have to kind of always monitor and see. Obviously, that was the talk to move it out of Fannie Mae and Freddie Mac. To your point, are kind of quasi government agencies. So if we're going to move it outside the government's control to see what would ever happen to it. But to your point, I don't know if we'll ever see that truly happen.
And granted, we'll never say never, right? And I know I said it will never happen. The end of the day here, the private investor doesn't want to be involved in the mortgage market anymore. So that's just kind of what it is today in today's world. Right. I don't know. Do we have any questions? I know there's something down there. I can't really make it out. I was trying to see.
No questions just far. If you do have questions, you definitely put in a comment. Jason Tilley said, watching live, amazing breakdown. Appreciate that, Jason. And then Damien said, I'm learning so much right now. So appreciate that.
Oh, yeah, absolutely. I mean, that's why we wanted to do it. I was trying to squint to see that out of my screen. I was losing my eyesight there for a moment, so I figured I might as well let the audience know. Why is Vince squinting down on the computer screen? So,
it's tough. Honestly, as we get older, I can tell my eyes are, on the computer screen. It's like I need bigger font. It's like
these are readers. These are not glasses. My eyesight's fine. I just can't read a computer screen.
We do have a question that just came in. Amy, she just sent a question. What role does inflation play in determining mortgage rates?
To me, it doesn't, because mortgage rates are fixed. Inflation's a variable thing. I mean, I get it from a cost of living standpoint. That's inflation, right? Hey, how much is my eggs? How much is butter? How much is bread? But your mortgage is a fixed rate. It doesn't go back down once you have it. So it's very little to me that it affects mortgage rates.
I might have an opposite opinion, but I mean, I guess it depends how she's phrasing that. If she's talking about like if the Federal Reserve is meeting and they see that inflation is, people are buying more and more of the resources that we have. I think their job is to kind of keep it at a moderate pace. So if we're seeing a bunch of purchasing going of resources, then yes, it does affect it. You would then see rates go higher. I think the decision from the Fed funds, you would see the Fed funds rate increase, not decrease, if you see resources getting bought up too quickly.
Okay.
So
And I apologize. Maybe I misunderstood it. I more looked at your mortgage is really a hedge against inflation. Your actual mortgage payment.
sure. Yeah, so I mean, what role does inflation play in determining mortgage rates? So I think if she's taking it from a Federal Reserve, if Jerome Powell sees inflation has, ticked up to 4 or 5%, right now we're roughly at about 2.9. We
Well,
know
then
rates are going to go.
they're gonna cut. They're gonna right. Rates
Yeah,
are going higher. They're gonna reduce rates.
correct, correct, correct. So if a situation is um, unemployment, if unemployment goes to an all-time low, then rates would go up too, right? I mean, only if unemployment spikes up is when, oh, I need to reduce the rates.
Correct. Right.
Right.
Low unemployment means rates aren't really. There's. I'm sorry. Low unemployment is negative for creates low unemployment creates lower interest rates. Higher unemployment, people losing their jobs, creates the Fed creates a cut to the Fed when people
Right.
are losing their job.
Correct. So inverse, basically an inverse relationship. Most of
Yep.
these things are inverse, so they're opposites of each other. So if we see high inflation, we're going to see rates get cut. If we see low unemployment, then really, the Fed has a decision. They don't necessarily have to increase, but obviously there's not an impact. They don't need to lower it,
It's the
based on that.
balance. It's the balancing act. That's what the
100%.
Fed's real job is, to balance everything that could potentially touch and affect the economy.
Yeah, so at the end of the day, we are looking at, the Federal Reserve look at inflation and unemployment. Those are the two factors that they really look at to kind of determine what do we need to do as far as the loan goes. And then, one of the key things was that obviously, I just saw Michael Moss. Thank you for listening. I appreciate that. He said he loves your Monopoly example.
I can see that. Thank you,
So he
Michael.
Yeah, and that's from Maryland. Michael's from Maryland, so appreciate you listening in. But yeah, I mean, the Federal Reserve, is going to meet, on Wednesday, 2-day meeting. Expectation is it's going to be flat. I agree with that. We don't anticipate anything, but we do know President Trump and others are pushing for him to, hey, make a move, make a slight move or something. But he hasn't. He hasn't moved. Jerome Powell is the Fed chairman, and he hasn't made a move yet.
And last week Trump went to the Fed. They were showing about the construction and all the costs. Again, political play and everything else to go with it. Powell I think they'll wind up making a little bit of a statement towards an easing, because they said we said we were going to get 2 cuts this year, so we got to at least get one of the two.
Right.
Otherwise, the end investors or people that run Wall Street are just going to look at this and know come May of next year, there's a new Fed guy coming in, and all they're going to do is cut. Exactly. So if you can time the market and know exactly it's going to happen, it's not going to go anywhere and it's not going to do anything.
Correct. And obviously this segues right into, the kind of the last thing I know we wanted to touch on was, should I wait for rates to drop before buying?
No. And I'm not saying that just as a salesperson that we sell loans. If you're buying a house, you're buying a house. The rate difference at this point in time, at the time you're looking to buy to the time you're waiting, you're talking a 3 or 4 or 5 month window. And what is it that you're actually potentially going to save? Because you can always redo the loan. Mm-hmm. And if rates go down, values are going to go up. So it's going to cost you more money to get into the home.
Right, and we've had the topic obviously. We want to marry the house, but we date the rate, right? We date the rate, meaning that we keep the rate flexible. We know that we can refinance after 6 months of making payments. So let's just, hey, let me get the house because the house today may not be there if I'm waiting for this rate to be magically there. So if it fits your needs and wants, you have to go now. There is no wait.
There's
There's
no there's no way.
no, because there's still not enough inventory that is move-in, ready to go, because you're still getting multiple bid situations on houses that are move-in ready. You know,
And to kind of just to add to that, the waiting for rates to drop, just look at the increase in the average age of a first-time home buyer over the last 4 years. And you would probably look at a chart and you probably would go from 34 to basically 38 to 39. So how much more can you wait to buy a home when you're almost 40 years old? You have to start looking at buying the house as soon as possible. But that comes down to the cost of homes today. It's not about the rate, because if you can buy a house today, you could afford $100 more in payment.
right?
You may not want it, but you can afford it. And that's the difference of, it's the right time to buy a house is when you're ready, not about the interest rate.
Yeah. What are some creative ways that you're thinking of helping clients win in today's higher rate environment? What are some things
Well,
you think we could do?
I mean, houses are sitting on the market a little bit longer today. So, I mean, I'm not saying it's a buyer's market yet. It's shifting. Um, Concessions are big. Get the seller closing cost credits to try and help you reduce your out of pocket on top of the down payment money. I know a lot of people also talk about buy downs. I'm not a fan of the buy down because you're in a marketplace now where rates should tentatively come down in the next 6 months. Buy downs were very popular in the start of 22 and 23 because you were buying down just from 4% to get it back into the low threes, or from 5%, you're buying it down from the 4 to 4. Today, you're talking an average interest rate today, 6.75. So buying that rate down is going to cost you more than what you think it's worth over the long run, especially if rates come down in the next 6 to 12 months.
Yeah, this is a really a pocket driven a real estate environment, and we'll probably get a realtor on with us one of these episodes. But it's really pocket driven, meaning it just depends on the neighborhood and the location of the property. I'm seeing a lot of stuff sit in certain areas, not as much in other areas. So it kind of it's real spotty. It's not really consistent, congruent all the way around, and that's from state to state, region to region. It's just real spotty. We're seeing some softening in some areas, and maybe that has something to do with potential unemployment or job layoffs. Because people are kind of, to your point, they don't know what tariffs are going to do or not, so they're kind of just staying status quo, and they're trimming some of the fat if they can. And kind of your example, last in, first out is kind of the mindset. Hey, we had you, but now we got to let you go.
Yeah, I mean, and the other thing too, right? I mean, it's hard to say like, wow, the price of homes are this expensive, and I'm going to get into the marketplace today.
Right.
I mean, it's hard to make that commitment with that fear of values are going to drop. What happens if they do, right? And well, if they do, you still have a house,
Exactly.
right? I mean, you still needed a place to live, so it's not really, it's a paper loss. I mean, and again, no one wants to talk about '07 or '08, but I mean, people were selling houses in the 150s to one and a quarter in the area that I lived at. Now those houses are 350. And I mean, yeah, that's a 20-year period basically, but that's a tremendous increase from what it was. So to me, that's why I said I don't really think values of home are going to drop significantly. If
No.
we see something, maybe a 5% drop over the next 12 months,
Sure.
I don't think anything more than that. I don't know if you have anything to add to that.
Well, no, I mean everything that you said is right on the money. I just, to your point, I went ahead and just got a contract. I took a look at it. Sales price is 195, which is way underneath market value. Maybe not a quote unquote in the most desirable area. And the seller, knowing that, increased seller credits to 6% on a FHA loan. So I mean, that's what so that would be, oh, are we in a buyer's market per se? Because of in certain areas, when it's not as enticing, where the location doesn't necessarily sell itself, the sellers are going to have to be willing to, come out of a little bit of their proceeds to, shake it enough where the buyer's like, oh yeah, this is too good to pass up.
Correct. Yeah.
So we're seeing that for sure. Let's do some let's do some recap right here. So when the Fed cuts rates, mortgage rates go down immediately. The answer is
No.
no. That is correct. Um, and just we've talked about it for over close to an hour now, that the federal funds rate that you hear, because so many people, the amount of phone calls, not to say I don't want the phone calls, but the amount of phone calls where people call and think like, Dante, I just saw rates drop.
Yep.
Hey, now what can you do for me? And I'm like, nothing has happened. Like, no, we're not directly connected.
It just and granted, we always like to give information. So this is more for a conventional interest rate. And I'm not big on rate boards and telling clients like, here, go look at this or go look at that. But Freddie Mac, the website's FreddieMac.com, every Wednesday puts out an average conventional interest rate that's based on a 740 credit score and 20% down. So please don't go to that website and then call Dante and say, hey, my rate is this and this is that. I'm just giving that information as a tool that when the Fed does start to cut rates, you can kind of use that as a barometer to see what is actually happening to the marketplace.
Exactly. Oh, it's good. And I'm sure we got realtor.com, we got Redfin, we got all these different platforms that give you this hypothetical numbers. But it is, to your point, based on sometimes different parameters than what you may actually be. So, you may not be a 740 score, you might be 680. You may not be a 720 score, and you definitely may not be putting 20% down. You're putting 3.5% down, or you're looking for 3% down. So these are different parameters that can adjust the interest rates. So be mindful of that. Those are just parameters to try to give you some type of guidance. Know that that's going to be somewhat in the ballpark, but that's not exactly what you're going to be getting.
Yeah. I mean, and the reason I basically did that is I put clients out to those websites when they have rate questions. And they basically say, hey, I don't control this. This is the government organization that backs housing. This is just to give you an idea.
Exactly. And then, what, to your point, we're not going in a housing crash, right? You don't
No.
see the bubble bursting.
No. I mean, if we take back and look back at 07, 08, what was going on? We were having major job losses, right?
Sure.
And again, without the job losses, you're not going to have foreclosures and evictions and everything that goes with it. And at the end, everybody has, well, I shouldn't say everybody, but those that bought their home prior to 2020 have equity. And when you wind up getting caught in a position, you're going to sell your house before you allow it to foreclose. In 07 and 08, the value was under the purchase price. You lost money, and you didn't have to put any money into the property to purchase it. So it was much easier to walk away from it because, like you've said before in the past, you didn't earn the interest rate you got. It was given to you. Back in 07, 08, you didn't work for the house that you got. It was given to you because the programs allowed you to buy a house with no money down. Correct. Completely different marketplaces. Never say never, but at the end of the day, if housing values would drop 5%, it's not going to change you from doing what you need to do, whether that's to buy the next one or continue to hold the one you have. The end of the day, if rates drop, values increase.
And one thing I would add to that, also too, is just the concept of the generations. Millennials have now surpassed the baby boomers. So, the millennials, as well as Gen Z, is in second place. Baby boomers are in third. Obviously followed by Gen X and then the Gen Alphas. So, I mean, with that being said, when you kind of talk about that and that concept, just what are, 20-year-olds to 43-year-olds doing? They generally are starting families, buying homes, that type of situation. They're investing, whether they're buying a primary or they're investing in property. They know real estate is a good way to start, building some type of portfolio. And so that, therefore, I don't see any decline I don't see any decline whatsoever in that situation. So that's a good situation to be in
I
right
would
now for
take
the real estate market.
Yeah, I take that one step further for the millennials. They're not committed to their job. They like to change their jobs every 2 or 3 years because that's how you get paid a higher wages, by leveraging what you did in your previous job. Where I rather sit in my company that I'm at, just in my group of age group, my friends, but they're going to go and say, hey, I worked here for 2 years. Now I want to go take my $120,000, go for the 150. And they're going to always be changing jobs at a much faster pace than what we've noticed in the economy over the last 40 years. Let's just say that.
Sure.
So puts a little pressure on everything. But yes, housing's very stable. And, population growth is still there. So we still have another reason to that. Household formations are still there.
Right.
So, I know we're getting close to our hour here. I know you like to kind of wrap things up. I don't think we have any other questions.
No, I don't think so. I mean, obviously, appreciate, it shows 337 people were listening. So appreciate everyone listening. If you had questions, always put them in the comments. We'll try to get to them. Appreciate us. Appreciate you, Vince, for joining.
Yeah, man, thanks for having me again. I know we're going to do this every Monday for the next couple. I know I committed all the way up through September. So, I'm going to be here every Monday, whether you like me or not. No, I'm only kidding on that. You guys can reach me. I do have an Epic email. It's vince@epic.mortgage. That's, again, vince@epic.mortgage. I think I messed that up last week. Dante corrected me with the .com thing, so I wanted to make sure we get that out there. And then, again, I'll have you wrap up to your audience. And, again, I appreciate you having me on the show.
No, thanks for coming on. Hey, so once again, Wednesdays we have, on YouTube, Epic Spotlight. We have our podcast. Check out the next interview that's going to be coming out on Wednesday. Just so you guys know, appreciate everyone's support on that. Our Epic Spotlight podcast is ranked 180 on the Apple rankings for the business category. So that's pretty huge. We're actually being ranked. I didn't even realize that. So I really appreciate everyone's support on that. So Epic Spotlight podcast will be out, a new interview on Wednesday. And then definitely check out some monologues that I do on answering your guys' questions. So when you guys have questions, I'll formulate a long-winded answer. Hopefully you guys appreciate it. Hopefully you like it. Hopefully you enjoy it. I try to put a little humor into it, but I do want to answer those questions for you guys, make you comfortable in real estate. It's a great opportunity, whether you're buying your first home, you're investing for the first time, towards your future. And if you do need to refinance, we're here for you on that. So appreciate you. We'll be back next Monday, just like Vince said, 12 p.m. Central. And we'll have another topic. Vince, you got any teasers for next week?
I mean, we're going to do that. All right. Here's a teaser for next week. So this is basically about what we're going to talk about next week. There's 3 types of mortgages. There's VA, FHA, and conventional. And I think next week what we're going to do is we're going to do a little breakdown, 15 minutes on FHA, 15 minutes on conventional, 15 minutes on VA. So you realtors out there, just basically the 411 or a quick 101 to each one of those loan programs. I don't know if that's going to be the tease of next week. Dante will make the decision on that one, just like the Cubs beat out the White Sox this week on the baseball.
Geez. So you had to bring that up.
But everything of course, I had to bring that up. I got to get going, man. Thanks for having me on the show, man. Have a great week, everyone. Take care.
All right, take care.
Bye.